Hey everyone, welcome to Breakout Wednesday for the 4th of May 2022. It is currently coming up to 4 p.m. on the West Coast and 6 p.m. on the East Coast. First of all, remember, this is never financial advice. I'm not a financial advisor. This is simply a video blog on how one trader sees the market, and everyone needs to take responsibility for their own decisions. Okay, quickly, chart of the NASDAQ, which is, broke low, broke back up, so it'll be interesting to see what that does in the short term. On the All Ords in Australia, we are stuck in sideways chop really just since August last year, and it's not the easiest market for anyone. Okay, now there's still some good trades though, so let's just quickly, there's some long-term stuff I want to talk about. 2 weeks ago, a lot of people want to hear more about the long-term position trading and all that, so I'm going to talk about that. And then and just quickly, last week's trades, the trades I've been kind of talking about. FHE, went nuts, had this huge breakout. Last week, I believe, was this day here when we had kind of closed back inside the base. Then the next day, it just went crazy. And then the day after that, wicked up super high. And so ended up being an awesome trade. And I've scaled out of that position in 4 different lots. So I'm out of that thing. This is not the sort of market that I'm going to just hold on and hope and dream that they keep going, because the odds are they're not going to. Quick example of that, the NC1 trade I was in that I mentioned, I stopped out here when it was breaking down below this little, I'll just go to this, below this little flag here, out there, and now it obviously, thank God for stop losses, right? So it's sort of market where if I can make some quick cash and get out, I'm going to get out before these things crash back down to earth. Some other quick trades, had a loser in PPM. Okay, I've managed to keep the losers down lately, but this is 100% a loser, and PPM sucked me in here and stopped me out here, so that is a loss on PPM. And I take losses like that these days without really registering it. It's just part of trading. It's just like a small business owner that has to, get a new roof or has to pay the, payroll that week. It's just a cost of doing business, and you need to expect to, win 50% of the time. So mentally, I'm prepared for this to happen 50% of the time, and it just doesn't get me down, or I don't really even think about it, to be honest. And then the next trade, COH. I have scratched COH. Actually, I took a small profit on COH. It was pretty much a break-even trade. I've given that long enough. In this sort of market, this is a really good company. It's probably going to be a lot higher in the future, but this is in my trading account, this one, and enough is enough, and I'm out of it. So I've got pretty heavy cash at the moment, very few trades active, and that's cool with me. Now, I'm going to get into some long-term stuff, but just quickly, a few things I'm watching. On Twitter, I've been talking about some shorts I've been in. Actually, I was talking about one in Twitter, but A2M, I was posted this to Twitter when it was setting up back here, and there is some great money to be made in shorting, and this is a bear market, right? And so obviously it's probably easier to make money shorting at the moment than going long. And this is just one good example. I don't post all the stuff to Twitter, but I did for some reason this one. And stocks in big downtrends tend to continue and did big downtrends, just like stocks in uptrends in a bull market tend to keep going up. And so I'm certainly not adverse to shorting. NAN is setting up in a base, and it's got pretty much nothing below it. Hey, just zooming back, and there's just no support there. If that was inverted and we were in a bull market, I think a lot of breakout traders would be looking at thinking, "Shit, it's perfect," and they'd be getting ready to trade that breakout. But because it's set up in a short setup, most people don't really look at it. Anyway, it's interesting, but there are 2 ways to play a market. Now, on the long side, there are a few setups: HZN, Horizon, obviously an oil stock, base in away. And oil stocks in an inflationary world, and with interest rates going up and blah, 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 and oil prices doing what they're doing, can do their own thing, as we've learned so far this year, and buck the overall trend of the market. So HZN is setting up. And another oil one, which is listed overseas, USOI, is setting up, and I'm not going to go into the fundamentals behind this thing, but the setup's a setup, and it's setting up there with blue sky above it. And just another little one on the ASX that I'm just watching closely at the moment is SRL. Okay, so SRL is a Sunrise Energy setting up here in this really tight base, and it might just fall out of that base at the moment and just come back in. In which case I'll just keep it on the watch list. But I like how tight this is. I like that it didn't break out here and it's just stuck within this range. And just watching this to see if it can kind of stay within this range for another week, another 5 trading days, and then if it can stay in that range of tiny volume for another 5 trading days, then it's going to be a fantastic setup. Okay, so that is it in terms of what I'm looking at. I mean, there's other stuff, but they are the main ones that I want to talk about now. Just talking on, just moving quickly on to kind of how I manage positions that I want to be in for a long period of time. From a position trading, point of view. And I've talked about it before, but Stan Weinstein, I mean, I didn't invent this stuff, right? I'm just copying some other dude's ideas. And I swear to God, his book is the best investing and trading book I've ever come across. And he has he invented this really simple way. I know a lot of people already know this, but just super quick, because there's always new people coming and going, right? So he invented a really, really easy way to invest in stocks. Okay, or anything really. And this is called a stage 1 where something's basing. This is called a stage 2 when something's going up. This is called a stage 3 when it's done going up and it's exhausted and it's matured and it's saturated and all that, and it's just flattening out at the top. And this is a stage 4 and it's breaking down. Okay, obviously it doesn't work this perfectly in the real world, but I'm going to show a few examples of why this makes sense. And with my positions, even in my trading account, as people that watch this regularly, when I'm trading, I always really want to be in stocks in a stage 2 when I'm going long, because I want all the odds behind me. So that's why I look at 150 or 200 day moving average, or this is a 30-week moving average on a weekly chart, but to really guide me, because there's an argument that a stock isn't really ready for a proper rally until it's based for long enough. And for it to base long enough, then eventually you need these long-term moving averages to start sloping up. And it's not a factor of missing. I think people that hate moving averages say you're going to miss most of the move. And I mean, I don't think that's true, because I think if you study enough charts, you realize that the exceptions always, of course, but that a stock really needs to base long enough and ages and ages and ages before it can have a big move. And therefore, the stocks that just go straight up, I don't really want to know about. And anyway, this is just a way of systematically doing it, and having a system and rules it's kind of like a religion to just live by. It really has served me incredibly well. And so what I'm going to quickly do is just look at some examples from classic stocks that everyone knows about, and explain how stage 2 analysis. So stage analysis is so good. So this is a chart of Netflix, okay, and I'm going to go all the way back to 2016. Just one sec. Okay, so here's Netflix back in 2016. The COVID crash really kind of stuffed a lot of charts up, so it's just easy for this purpose of this exercise to go back. And here's Netflix in 2016. Okay, just zooming in, just chopping away. It's had a big rally. This is I'm not going to talk about all this stuff. Had a big rally, and then it chopped down and just really went sideways for over a year. Okay, eventually. I'm not, I never try and buy these things or buy these things or buy these things. And, really just wait for this moving average to start sloping up, just like in this graph, okay? And then I'd look for a nice, clear, clean base. I remember this, 16 really well. It wasn't that long ago. And it just gave the nicest, cleanest base above its 30-week moving average, and then it starts just breaking up. Okay, then the idea in a long-term account, so for me it's a different structure that I invest in, but it can be your own name or whatever structure the hell you want, but I really just plan to ride these using wide stops. So even use a 30-week, or you can use a 150-day or 200-day moving average or whatever. And the idea is that something's good happening in this company. This company is growing. I tend to always do a lot of reading and learn all about that company, and to give me conviction, because without conviction, it's got nothing, okay? It really does help to have a ridiculous amount of conviction for these moves. But I'm really trying to couple it with stocks that I believe in, like that have huge earnings growth and huge, fundamentals that I like, a story that I like. Try not to get married to it too much in case it doesn't work out and I need to get stopped out. But the more conviction I have is what the point I'm trying to make, the better, more chance I have of holding these things. And I really try and stay with them whilst they're in a stage 2 advance. Okay. And then when there's enough evidence that they're out of stage 2 advance, like it starts breaking below the 30-week moving average, I'll be getting out. Okay, I might trim some when it goes parabolic and all that sort of stuff, but and then I really just keep an open mind that not always does it top out into a stage 3 and then go all the way back to where it came from. That doesn't always happen. Sometimes it will just go into a stage 3 top in, and then that will turn into another stage 1. Okay, it was like a stage 3 continuation base, which is what happened here. And this is not as nice a move. It's a bit more choppy, but and then it goes back on its merry way. Okay, until it finally tops out. And then if you look what's happened recently on Netflix, there is just no reason to ever hold anything as it starts breaking below its 30-week moving average. This is where all the bad things happen, and stocks tend to give you a lot of time to get out of them. Okay, and it's just, I find it amazing that people, hedge funds and managed funds they're managing so much money, just don't follow simple rules that have been around for decades and have been proven time and again that they work. All right, and so let's just quickly do another one. I could do them all day long, but let's just look at the big end of town at CBA and just clean this up because that's a mess. Okay, and so a 30-week average moving average on CBA, and I just wanted to go back in time a little bit. Okay, so yeah, this is where I wanted to go. So after the GFC, obviously it got clobbered in the GFC. Okay, a big 2 legs down, A, B, C, and then just really had a huge rally and then just base for ages. Now I remember this time period because everyone was checking out from the stock market and saying it was all too hard and blah, 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 blah. Whereas CBA just put this huge base in where the 30-week moving average was churning sideways and it turned up, and then it started just clearing all these highs and this big base, and then it just had a massive run. Okay, and so this is just a way of just making sure that you're always in stage 2 advances, breaking out from huge stage 1 bases, just like this. Okay, and just living by those rules, and it tends to work out pretty well. Now, I just wanted to go back to the current moment in time, just to some stocks I have been talking about recently. So this is one that I've been talking about, CGF. Okay, and so I have a position in CGF that I've talked about, and I'm still in it. And so CGF is I'm not going to go into the fundamentals, but a financial stock had this huge stage 4 decline where it went from $14 to $2 something during the COVID crash. Then it kind of had this massive COVID rally, and then just spent from ages basing. Like, what's that? Like, it's well over a year. Hey, yeah. So over a year basing. Okay, and remember, this is a weekly chart with 30-week moving average, and I've and I see this huge base forming. I see the 30-week moving average sloping up. I think this has got a very, very, very good chance that this is a stage 1 base, and that therefore the move ahead of it, because it's a big base with really nice tightening action stuff, therefore the chance of this having a big move is way, way better than 50%. Okay, and obviously this has a lot of room to go. And then I always read its, check out its earnings, and just get a bit of conviction behind it to make sure that I'm dealing with a company that has money in the bank, and it's not some sort of crappy business, right? And so then once I have that conviction, I will take a position with a wider stop loss than normal, and I will really just not look at it. Like, I look at CGF maybe once a week. I try and never look at it. It's in the self-managed super fund. There's nothing to be gained by looking at it every day. I just be patient. Okay. And another example, and I'll go back to that one in a sec, but another example of another one from last year that I talked about heaps was Origin. Okay, and Origin started, this is a massive stage 4 decline, blah, 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 blah. Then the 30-week moving average started tipping up here, and it started breaking out of this massive base here, which I was talking about in a lot of detail back when I was actually breaking out. And this thing is still in the stage 2 advance. And it's going to go higher than anyone probably thinks. It's just going to chop around a lot, and most people are not going to stick with it because it's going to be down 5% one week and they're going to wee their pants and sell out, and that's just not how you go about long-term investing or position trading. If you want to be in something for years, you need to be able to handle, you know, those 10-15% pullbacks. Okay, and then another example just from the current day, KLS. So and this stock, to be honest, isn't quite ready in the sense that the 30-week moving average is not really turning up. But this is a stock that had this huge stage 2 advance, topped out with a stage 3 topping pattern, fell with a stage 4, and then started putting in a new stage 1 base. And it's not perfect, it's not long enough, but you know, obviously, you know, this is an art, not a science. And so the moral of the story is that moving average is starting to turn. It is a pretty big stage 1 base, and it's just a way of analyzing what point of the life cycle is that stock in. Okay, and then the only other thing to really add is that I try and actually, one sec. Okay, so just quickly, this is Google back in 2014 and 15, which I remember super well as well. And like, the only reason I wanted to bring this one up quickly is that, you know, this perfect scenario here of stage 1, stage 2, stage 3, stage 4, it just doesn't always, it rarely works out that way. It can, like Netflix is doing it now, PayPal is doing it now, Shopify is doing it now. Like a lot of those stocks will turn to where they came from, but a lot of them don't. And a lot of the time you think it's a stage 3 and it's not, it's just a new base. Okay, and everyone starts panicking that, you know, well, stage analysis people start panicking that we're going into a stage 4 decline, and it will just chop about, and which is cool. So here's an example of Google that had this huge run, started putting in a topping pattern, but it was just a basing pattern and then broke up, and it was really only just getting started. Hey, okay, and so and then what I try and do to just help me ride these is I do a lot of Dava scans. So I'm just going to quickly do this scan. Okay, so I do these Dava scans. So this is CGF, which came up in a Dava scan, and it's like these stocks that are in massive bases, they tend to always come up in Dava scans, and that's how I find a lot of them. And I'll do these Dava scans, and I'll sometimes use these Davis boxes as stop losses, because I always put this extra little buffer on the bottom here. It's really good at just preventing getting whipped out from stop runs, okay, and fake and little shakeouts. And I will use the Davis box system that the Protrader kind of creates for me as a much wider stop than normal. So with CGF, you know, for the self-managed super fund, I ended at 7. I had a stop. It's actually even, I went a bit below this box, like I was down here somewhere, and it's quite a wide stop. I just give it room to wheel about and do its thing. And then I will look to add to it when it's breaking out of different boxes. So, you know, if this base is a bit longer and it breaks out of a box, I might just, you know, if I have the cash, any cash sitting in that managed super fund that's not deployed, I might just whack it in it if it's doing well. I'd much prefer to whack it in something that's working for me and pyramid into it and build a bigger position than kind of just add to something that is going down, or, you know, I think it's always better to add to winning positions than to, keep adding to losing positions, right? So, and anyway, that is that. And I was just going to show a few. Okay, and then here's just back again at Origin, and obviously the entry for Origin was back here. But then I always do my Dava scans and just see what's coming up, and if I have these in my, you know, super fund or whatever, then I will sometimes use these Davis boxes as my stop losses as these things are just trending up, okay? And I will add more sometimes and just use these trailing stops. So I still have some on Origin, not in my trading account with a long one, but I'm just using these stops, and I'm happy to have wide stops. I've been in for ages, and I definitely think it's key to be getting into these right at the start of the base breakout. Like, I'm trying not to add to overextended stocks that have already zoomed up a lot. I'm really trying to get in at the start of that stage 1 base breakout down here, okay? Not up here. I don't really want to, you know, I will get in up here and I will scout and I will short-term trade. And I think that's a key thing. Like, anything that's up here that's well into a stage 2 advance, to me, that's all about trading those stocks, like getting in, getting out, banking quick profits, blah, blah, blah. For me to hold something for a long time, like 1, 2, 3 years or 6 months, or really have a crack at sticking with something, I need to be getting it when it's just emerging from this primary stage 1 base, okay, because that's when my risk reward is best and the upside potential is best, all that sort of stuff, okay. All right, hope that made some sense. I'm going to check out. No crypto this week because it's been 20 minutes and I just going to pack my stuff up and get home. Cheers, everyone. Catch up.